Welcome to Private Banking Strategies Podcast with Vance Lowe and Seth Hicks, your secret weapon to protect your assets and never have to start over financially again. Vance and Seth help high net worth individuals, families, business owners, and investors structure an asset-protected, tax-free fortress for their families. Learn how to keep what you earn and use the velocity of money to create your own private banking system. Join us on this journey as we explore the secret strategies of the rich and political elite and help you take total control of your financial security. Now, on to the show.
Welcome back. I'm Gary Wilson, your host, and we're glad to have you back. We've got a great guest today, Seth Hicks. Seth, first of all, thank you very much for coming on board and sharing your wisdom and your valuable time with us today.
Thank you, Gary. Glad to be here.
Yep. Hey, if you wouldn't mind, we've had a great conversation, and I've read about you, and we could probably have 3 or 4 podcasts if we want, but what I thought we'd do is let's stick with what we talked about a moment ago about being the private banking alternative to financing and buying properties. But before we do, would you mind giving people a little bit of a background, like let them know how you got to where you are today? That'll provide some context, and we can go into meat and potatoes after that,
Sure. Yeah. Well, I am legally trained. I practiced law for about over 20 years and traditionally worked in a large law firm doing secured real estate transactions, and then migrated into a boutique firm in Los Angeles where I and a few other guys focused on real estate and business transactions, both in a secured transaction format and then also doing some litigation, some trial work. And what that helped me to form, Gary, was the planning, the asset planning, the asset protection structures and financial privacy that so many high net worth clients are after. I met Vance Lowe, my current partner at Private Banking Strategies, who was also here on your podcast half a decade ago and was introduced to private banking strategies. And what it really struck me as an amazing tool to help create an asset protection plan and financial privacy. And so I've become quite adept at structuring transactions and helping people form private banks in an asset protected way. It helps them keep what they make. Their cash is not out there in centralized banks subject to taking through Dodd-Frank or through other forms of creditor attack or financial privacy loss. So that's kind of the short version of the roadmap that got me to private banking strategies. It's just such a great pleasure to work with folks and help them get things settled so that they know that they can sleep well at night and they know that they're safe and their assets are protected.
Yeah. Well, I appreciate that. I know everybody listening is probably really interested now. We've had a few attorneys on over the years, but really you've got the know-how. So if we could, let's talk about what that actually is first, so people understand that the concept of private banking and what that entails, and then we can go into maybe some examples.
Sure. Well, private banking is where you take the banking equation back in your life. In normal context, they bank their money at generally large centralized banks, Wells Fargo, Bank of America, PNC, whatever the retail banking outlet is, generally because it's convenient or because for whatever they offer in business banking offer, or who knows what the question may be. But what they don't know is that their money is actually not safe in a centralized bank. And there was within the past decade, there was something called the Dodd-Frank Act passed. And what the Dodd-Frank Act did was it was interestingly named like a Consumer Protection Act. And it was in response to the mortgage crisis in 2007 and 2008, where the federal government bailed out financial institutions that were too big to fail. And taxpayers, they don't want to fund private corporation bailouts. So they were up in arms. Everybody who financed that would be not necessarily consenting to that. And it was unprecedented. Never happened before in American history. So the Dodd-Frank Consumer Protection Act, so-called Consumer Protection Act, what it did was say, okay, we're never going to use taxpayer money to bail out too big to fail financial institutions. Instead, if there's a bank insolvency, we're going to bail in on the deposits. You can take an IOU in bank stock or some other form of pennies on the dollar value, if any value is there at all. And so that to me is an unacceptable risk. To many of our clients, it's an unacceptable risk. Some folks may go, well, hey, what about the FDIC insurance? And if you actually do the math, and we won't get down the rabbit hole there, but you can do your own research. The FDIC is not solvent to pay all of the deposits that are out there in American banks. They're actually solvent to the tune of about 1.3 cents on every dollar. So I place no value in the FDIC insurance as well. It's a smokescreen and it won't save you. So as an alternative to that, we have placed people in the private banking world. And that's a whole life insurance contract that's carefully structured, that has the right terms with the insurance company, and that has performed for over 200 years in a way that's never failed to pay dividends. It's never imploded and is financially private. So that's kind of the simple explanation of a private bank. You're using a whole life insurance contract that's properly structured to bank your own cash assets. Now, here's one of the best kickers, Gary, is that in numerous states, they have codified law that says these contracts, which we like to call a vault, are completely asset protected from creditors. And they're financially private. The IRS is not required to be notified when you have large transactions in or large transactions out. It's pursuant to Internal Revenue Code 7702. Those whole life insurance contracts are carved out when properly structured. And so you've got financial privacy from the IRS. And within that private bank, your wealth grows and compounds annually tax-free. And when you want to take it out, there's no tax penalty. Unlike an IRA or some other government-sponsored retirement plan, you're able to put money in and take money out at your own control, when you want it, how you want it, without any tax consequence whatsoever. And if you're in one of the states that I described, 100% asset protected. So many of our clients say, well, that's a far superior option for us. And they begin to move their wealth out of centralized banks into their own private bank. So that's kind of the summary on what a private bank is.
Okay. So let's talk about an example of how a real estate investor can use that. Most of our listeners, I mean, a lot of business owners, lots of professionals, but everybody has one thing in common. They like investing in real estate. So we're always looking for alternative ways to structure deals and provide the financing as much as possible. Even if you have a case study, I mean, obviously can't share the names and addresses, but in an example, that would be awesome,
Absolutely. So let's take someone who has $100,000 in cash value in their private bank that they want to put to work in real estate investment. And we're going to kind of simplify the hypothetical here so that people can do the math quickly and in their head. Obviously, the actual numbers would change and depend on the asset, but they'll get the picture. So you take that $100,000 and you go and you buy an investment property that cost $100,000 somewhere in the South, perhaps. And we're going to assume that this property cash flows at net $25,000 a year. Okay. So every month you're pulling in that cash flow and you're putting it back into your bank, just like any borrower would service debt to a third-party lender like Wells Fargo or Bank of America. And with every dollar that's paid back into your bank, your cash value increases inside of your private bank and you can put it back to work. Now, if in this particular scenario, it's going to take you a number of years to build up another $100,000 or 100,000 plus to buy another property. So what, numerous clients like to do is use leverage. And I'm sure our audience is being real estate investors familiar with the concept of leverage. Let's say that now we've got 5 different real estate assets that we want to acquire that are all $100,000, and we can qualify for 80-20 financing, where we put 20% down and we use third-party financing at 80%. We're going to buy 5 properties. We still put that same $100,000 to work in the acquisition of those 5 properties, and the bank funds the other 80%. But now, instead of having $25,000 per property in cash flow, we've got 5 times that and $125,000 in cash flow in that first year. So we can actually take out the third-party financing on property number 1 and part of property number 2 in year number 1. And instead of having a first and a second, the first, let's say, to Wells Fargo and the second to our private bank, now all we've got is a completely equity stripped property to our private bank. And that private bank, just by the way it's structured, is in a way such that we're in an arm's length transaction. Our private bank is an entity, and that entity is dissimilar from our borrower. And so the borrower actually services the debt back to our private bank and continues to service that debt. But in effect, it's all intra-family income. And that's what we call the velocity of money. You're getting multiple touches on that dollar. You financed your bank with that dollar. You lent it out to purchase a property. You've got a cash flow on that same dollar and rental income coming right back to your bank, and you can put it right back to work. So that's the velocity of money that's created, and you get a multiple touches with your private bank and real estate. Now let's go into year 2 just real quick. I got another $125,000 in year 2. You're able to pay off property 2 and property 3, and you've got 3 properties that are effectively free and clear of third-party financing, and your bank still has all of that cash flow coming in that you're piling up. And pretty soon you'll be able to rinse and repeat and go into the next set of properties or an apartment or whatever other type of asset that you want to target. And as that trajectory grows, Gary, the sky's the limit. So
All right. Well, I'll tell you what, this has sounded pretty interesting. We basically build up the cash value in the life insurance policy. We borrow against it. So we leave the money in there. We're just borrowing or leveraging. We're borrowing against it to buy the property, or even make a down payment on a property. And then when we pay it back, so the rents are coming on the property, we use the rent proceeds to pay back the loan. It's a loan against the cash value. So does that mean the cash value is still sitting there building up? Like, in other words, is it earning money internally through the life insurance company? Its own dividend or return could be 3%, 6%, something like that. Is that still going on while we're doing the borrowing?
absolutely. Yeah, it's called a non-direct recognition structure. And they treat it as if there was no money loaned out of the bank in a non-direct recognition policy, so that the dividends are accruing based on $100,000, even when you put that $100,000 out to work for you. And the companies that we use haven't failed to pay a dividend since the Civil War. So before the Civil War, they never failed to pay dividends. So that's one of the things that we like to accentuate. I mean, this is a slow and steady. Some people go, well, I could go make more money in this investment or that investment. You can't when you analyze these internal rates of return and use the velocity of money here. You're not going to be able to beat that. And it's not asset protected, and it's not secured, and it's not financially private. So for the folks that use this, there's nothing comparable out there.
Yeah. Okay. Now on the money, on the loan coming, we're borrowing as the cash value, using that, let's just say 100,000 to buy a property, no other loan. We're just flat out going to pay, essentially, well, pay for the property outright. The interest that you pay on the loan, now, does that go back to you, since technically you're the banker? Is that in addition to the fact that your cash value is still actually making a return too? In other words, you're paying yourself back.
Right. And that's one of the things that my partner Vance loves to teach people about, is that you have to think like a banker. And as a banker that's putting money to work in lending transactions, you want the highest interest rate possible, and you want the cash flow that's cycled on that. So absolutely, you're thinking right, Gary. You want to ramp up interest rates as high as you possibly can. And that is all tax-free. So it's subject to your cash flow. If you've got rentals that are really screaming and rental cash flow, and you can set a mortgage instrument up at 20%, there's nothing to prohibit you from doing that. And all of that interest accumulates tax-free, compounds annually, tax-free as well.
Yeah, it's amazing. So you're making money three different ways. You've got the internal return from the whole life from the life insurance company giving you essentially I call it a dividend, but a rate of return on your cash value. Then you borrow against it. You're making money on the interest on that loan. It's because it's your money that you've borrowed. You also acquired an income producing asset, a physical, tangible asset, brick and mortar building somewhere that's going up in value and throwing off revenue through rents.
That's right. And you've got all the depreciation benefits that are so valuable with real estate.
Yeah. Hopefully that'll be here for a good long time. We'll have to, they talk about every administration, it comes up and they never do it. Thank goodness. I've been doing this since January 1986. And even back as far back as then, people were saying, yeah, we're going to do away with that interest write-off. And neither one has ever happened. And I don't believe any Congress or the administration is going to want to have that on the record, because they definitely will lose power for at least the next election. But in any case, so back to this now. Now, what are some alternative uses? Like my wheels are spinning. So could I borrow against my cash value in whatever that rate is, and I borrow with the interest rate, and make that a low rate, but then lend it out to an investor who wants to invest that doesn't want to use a traditional bank, and they're willing to pay me 10%. So maybe I borrow it at 5%, lend it out at 10%, and then those payments go back in to my account because it's my money. Is that a legitimate or an alternative use of the cash value?
Absolutely. Yeah, absolutely. And there's many folks that do precisely that. And one of our associates that had over 100 different policies, that's what their family focused on, was just third-party lending. And they made it a family business. They became private lenders. And that was that velocity and cyclical flow. And unlike a centralized bank that is, that's highly leveraged, or what some people call derivative lending, where we deposit $10 and they're able to lend out 100, and that's actually conservative. It's probably more like we deposit 4 and they lend out 100, or perhaps even more. And so that funny money that's just printed out of thin air, they're making interest on. Well, this is a more healthy economy, because these life insurance companies, they're not allowed to play by those same funny money rules. They have to have a dollar in reserve for every dollar that's to be accounted for.
Right.
And that's why they very rarely ever go insolvent. And when they do, they're snapped up by another life insurance company because of all the cash flow and the cash assets that are already on the books.
Did that story feel like it was about you? Do you feel like you are generating a lot of revenue, but are not moving forward as fast as you would like? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
A lot of people don't realize in the world of traditional lending, like you mentioned, the big banks, they're selling the mortgages, they're packaging them up and selling them to Wall Street in the form of this all started in the 70s. This is where you and I as a mutual fund investor can go online to Fidelity mutual funds and invest in a mortgage-backed security, which is simply a block of a tape. We used to call it a tape. Block of mortgages packaged together. Then what happens is the bank gets all that money back because they sell it to Wall Street. People like you and I buy shares of that. They get the money back and they can lend it again. And you're right, they've only got to keep a small percentage in loan loss reserves, right? They can lend that money out like 10 different times, because people always ask, well, how do banks make money when they're only charging 3%? And I'm like, well, they're not just charging 3%, they're charging 3% 10 times,
right,
on the $17. And you can see, you can look at a bank's health. There's some interesting websites. You can Google this stuff and find out which banks have defaulted assets. Remember, the loan to the consumer is a liability and the building is an asset. But to the bank, whoever's doing the lending, the loan is the asset, because that's the thing that's making money. So they call it loan loss reserves, and troubled asset ratio is the big thing. You look at a bank, if it has a troubled asset ratio, anything above zero means they've got loans if they're taken back in foreclosure. When the last recession occurred, that's why places like Countrywide had to be acquired by Bank of America. We would have been in an absolute depression. The numbers were all there. We mentioned this earlier. The healthy banks had to acquire the unhealthy banks, and it was a strong arm. It was the first time ever in history it was ever done. Just a brief history, our bank had actually sold our mortgage portfolio back well before the recession started because we saw what was going to happen. We were out of it, but we were forced to buy an unhealthy bank, another super regional sized bank, by using the money. We were told we had to use the money to do that. But at the end of the day, it worked. I mean, I don't agree with the philosophy, but let's face it worked. But the point here, guys, everybody listening, is what Seth is talking about is a way for you to separate yourself from all of that mess where you have no control, zero control. And in here, from what I'm hearing, Seth, we've got plenty of control,
You've got all the control. You've got complete liquidity. You're the one making the decisions. You've got no taxable event putting money in or taking money out. And as you acquire wealth in your private bank, obviously people use that to structure a retirement. And unlike a 401k or other government sponsored plan, you say, I need $25,000 a month. And when can I take it out? If you take it out too early in a government sponsored plan, you're going to be penalized. Take it out too late, you're going to be penalized. And no matter when you take it out, you're going to be paying taxes on it. So when you stack this up against a private banking structure where there's no taxable event in, no taxable event out, no penalty in, no penalty out, and you can use it for investment, you can use it for retirement, you've got absolute control and liquidity. It just doesn't make any sense to someone who can actually count those beans side by side and then stack the asset protection on top of it. And that's what people are after. They want to keep what they make, Gary. I mean, and in fact, with the hyperinflationary environment that we're in, you have to put your money to work and create cash flow and passive cash flow with investment assets and vehicles that are going to far surpass inflation, or you're losing purchasing power. You have no ability to plan. How much money do you need to retire? And people go, well, they generally underestimate that. And especially since the government has printed literally, I think, over $10 trillion within the last decade. And that may be a conservative investment. I'm not looking at those numbers, but I have in the past, and it's staggering, It's over $30 trillion in debt right now, our country. And with nothing backing that fiat currency, you've got this hyperinflationary environment. And so these are ways you have to have a velocity of money. You have to have your assets protected to be able to protect yourself against that coming onslaught.
I agree. It's interesting, and I'm not making a political commentary here, I promise, but if you think about that number, 30 trillion, very quickly it's going to be 33 trillion. And there's about 330 million people in the United States. So just imagine what that means mathematically, the debt load on the shoulders of the American people. It's just insane. If you and I, Seth, printed money like the government does, we'd be in federal prison.
Right.
And it's the whole statement backed by the full faith and credit of the United States government. It's meant to be our GDP, our gross domestic product, is what's the backing. And if you don't have it, you don't print it. It's just like any household. You can't live on debt. It eventually is going to collapse. There's some real reasons, guys, to really listen to this. And I'm doing it. Everybody I'm involved with, we've been studying this for the last 2 years. It's whole life insurance has been around for a long time. When I first got started, some of my friends and their parents, and early on some of my clients already were using whole life policies for a number of reasons, and this was one of them. It just wasn't like commonplace, But now it's becoming commonplace because people realize that anybody can participate in this, So what would someone do, Seth, that they want to actually take advantage of this? What's the first three things they need to do? I mean, how can they get a hold of you? Is there something they can read, a website, anything like that you can help
Sure.
Yeah.
Yeah, sure. Absolutely. Yeah, we've got a website, Gary, and it's privatebankingstrategies.com.
Mhm.
Once again, privatebankingstrategies.com. And on our website, we offer folks that are interested in learning more what we like to call a red pill book. And this red pill book tells you about secrets the banks don't want you to know and how to increase your wealth with some of these secrets. And we get into some of the same things we're describing on this show. And free to you, you can read it or you can listen to it on audio there. And then in exchange for your email address, we'll begin to give you value added email content, which varies in different subject matter, from cryptocurrency to asset protection to how to keep your financial footprint off the radar, and just really want to provide value for folks so that they can learn more and spot issues. And if those things are resonating with you, then what you do is you schedule a call with our team, and generally Vance, who's my partner, has those appointments with folks and really gets to know somebody's circumstances and lays out a framework for them and their particular circumstances as to how it would work for them. And ultimately, if they become a client, we lay out an 8-year roadmap, Gary, that tells them step by step exactly what they need to do. If they've got a lot of third-party debt, let's say, to other mortgage companies that they want to take out and begin to possess that equity in the real estate, we show them which ones to tackle, when to tackle it, and how to do it. And Vance really gives them a hands-on roadmap that tells them exactly what they need to do. So that's how it starts.
That's perfect. Now, I know we're getting close on time here, but I'm just thinking of the audience. So people who are like, they're around the retirement age, let's say they're 60, in their minds are going to be thinking, okay, can this still work for me? I still got gas in the tank. I'm going to be working for a few more years, but I'm sure everybody's had experience with life insurance along the way, either term life or whole life when they get their first job, and they realize as they age, the cost of whole life, all life insurance continues to go up. So what can you tell people who are right around that magical 60 mark and thinking, geez, do I have time to do this? Does it still make sense?
Well, sure. And that is a question that we often get from folks that are in their sunset years. But one of the great things that I like about private banking strategies is it's not just a retirement-minded vehicle. And some other folks in the industry, that's their paradigm. It's only for retirement. But me being an attorney and an asset protection specialist and focusing on these other things, it has such a much broader application. So some folks that are 60 and over, they want to protect their cash. They don't want it in a centralized bank. They want to put it in something that they have complete control over, and that's a primary motivation. And so they want to be financially private. They want to leave a legacy that's not swiped or cut in half with estate planning taxes, with estate taxes. And I've got a couple of just quick examples. We had a doctor that came to us that was in his 60s, and he had been sued for medical malpractice and actually had a verdict against him that was in excess of his insurance coverage. And so he was actually personally liable into the multiple millions, and it literally just destroyed his wealth, and he had to start all over in his 60s. That same application of this structure in his circumstances, he wouldn't have lost a penny, because he was in a state where all of his cash would have been asset protected. That judgment would have been absolutely worthless. It would have been as good as toilet paper, and he would have been behind the bulletproof shield that we like to call our vault, but he had to start over. Then here's another quick example. There's a recording artist that passed away called Prince. And Prince had about a $200 million estate when he died. He was a resident of Minnesota, and between the state of Minnesota and the federal government, they took over $100 million out of his estate from his beneficiaries' hands. And a simple asset protection structure and incorporation of private banking would have helped him to avoid that stripping of the wealth that he'd acquired for his heirs. And so I know you and I both, we have families and we have a purpose for wealth creation, and whatever that I don't use or put to work while I'm here on earth, I want to go to my beneficiaries, and I want it to go in a tax-free way. I already paid taxes to earn the money the first time. And so now transferring it to the next generation in my family, I don't want it to be cut in half and with taxation again. So that's another major issue that folks 60 and over are hot on that topic, Gary.
Yeah, I agree 100%. Well, I tell you what, I know we're always told we should try to keep them to a half hour or a little bit over, but I think people hung in there. Great subject. So I've got, see if I can read my writing here. Privatebankingstrategies.com. That's where people need to go and get started. And if everybody listening, take it seriously. I have, and a lot of the folks that I associate with have started doing the same thing. I'm stubborn. Some of them started before I did. But I'm so glad I did, because now that engine's already up and running, and it can be very rewarding. It can allow you to participate in real estate investing, keeping the control, and not being at the mercy of the big institutional banks. And Lord knows, well, this whole thing's going to end up down the road as far as the economy goes and this next correction. But why worry about it? Why not prepare for it by doing something like this? So, Seth, any final words of wisdom or parting well wishes for people before we get going here?
Yeah, I just want to thank you for having us on the show, Gary, and would love to work with your audience. We have a strong clientele in the real estate investor niche, and we've got a lot of folks in the investment and business culture. That's most of our clientele. So we cater to that type of folks, and we'll be well-versed to help them accomplish their goals for financial freedom and put this to work for them. Be glad to help them.
Yeah. If you're an agent, by the way, if you're a real estate agent, listen to this. Well, you need to tap in. I mean, things are going to start to change. In fact, they already have. And you want to be on the front end of it, not on the back end. Don't be like the other agents that will evaporate in a matter of a few short years. I mean, it happened the last time. Half of them were gone, guys. Don't be that half. Be the better half. Be the smarter half. Be the successful half that makes the changes you need to make now. So go into that website. You can click on a button that says, just have a conversation with me or one of the folks on the team, and we'll show you how to be an investor agent. It's an awesome way to make money. It's easy, puts you in the game of investing yourself.
Did that story feel like it was about you? Do you feel you should be making more progress toward your financial goals? Do you feel stuck? Let us help you get unstuck. Are you ready to take action and get your own private bank? Please visit us at www.privatebankingstrategies.com.
Thank you for listening to the Private Banking Strategies podcast. Click the subscribe button below to be notified when new episodes become available.